everybody. Welcome to today's episode of the Daily Dose. Today is Thursday, December 1st. I hope everybody had a great day. I titled this episode Why We Still Have to Be Cautious Investors for a couple reasons. I think a lot of people think that the worst is behind us now that the Fed's slowing down their interest rates and that everything's going to be great from here. And while there are definitely good things happening in this market, I think that you also have to be prudent and very careful and manage your risk, as always. So I wanted to use this episode as a little reminder of that. So before I get into this article and kind of read through it, I just kind of want to talk through my my thoughts, I guess. So the first reason why the worst might not be behind us yet is because a lot of the rate hiking that we've seen the past couple months, a lot of the aftermath of that and the effects in the economy are going to be lagging. So a lot of that is still coming for us. So we're still just now starting to feel the effects of that huge, back to back to back to back months of 75 basis point rate hikes. That's still coming, in my opinion. That's usually how it works in a rate hike cycle, and especially that they raised it so hard so fast. It's going to take a little bit to feel those effects. We're just now starting to see unemployment rise. We're starting to see people lose their jobs. We're seeing a lot more strain as far as small businesses go. We're seeing a lot of gigantic public companies, their earnings start to recede. We're just now starting to kind of feel the effects of that rate hike cycle. So just because they're talking about slowing down rate hikes doesn't mean that all of a sudden the stock market's just going to go straight up. Additionally, the general sentiment among retail investors or among dumb money is extremely bullish now. That the bottom's in. We're just gonna go straight up from here. We're gonna break out of this downtrend. We're done with this bear market. And usually you want to be doing the exact opposite of what dumb money's doing. And we're seeing a lot of dumb money come into this market. And we're seeing a lot of smart money kind of hold back on new investments. And usually that's a pretty telling indicator when you have smart money and dumb money kind of diverging like that. And the third reason why we need to still be cautious investors is because typically after a rate hike cycle is completed and they pause raising rates, and even after they start cutting rates, the bottom of the bear market usually is not in. We don't see a bottom in the market until around 2 months after they start cutting rates. So contrary to popular belief, though the markets actually don't reach a bottom point, history tells us, until around 2 months after the Fed starts cutting rates. And we're not even to the point where they're going to stop raising rates yet. So it's important for us to manage our risk going forward, because we still might get that next leg down. That's what history is telling us. And when you see the retail sentiment the way it is, usually they get washed out. So it's important for us to manage our risk. I'm not here to scare people, but I'm here to help people be cautious, be prudent, and be smart with their investments. So that's really the most important thing. So let's get into the article today, because this article was titled "Stocks Fall Despite Lighter Reading on Fed's Key Inflation Gauge." So it's like kind of that general sentiment. It's like, hey, inflation's cooling off, and the Fed is talking about starting to slow down the pace of their rate hike. So why aren't the markets just going straight up? And for the most part, the last couple weeks they have been going up. But is that going to continue? And history would tell us no. So let's get into this. U.S. stocks barreled lower Thursday in a downbeat start to December as fears of a recession appeared to outweigh easing inflation and signals of a slower pace and magnitude of rate increases as soon as later this month. The S&P 500 slipped 0.2%, while the Dow Jones Industrial Average erased nearly 0.8%, and the Nasdaq actually was higher. In other pockets of the market, the U.S. dollar index retreated to a 3-month low, and U.S. Treasury yields held steady after sharp declines. The Core Personal Consumption Expenditures Price Index, or the PCE, an inflation measure closely watched by the Federal Reserve, rose 0.2% in October, and that was less than expected. Meanwhile, filings for unemployment insurance fell last week, holding near historic lows. Initial jobless claims, the most timely snapshot of the labor market, came in at 225,000 for the week ended November 26th, and that was a decrease of 16,000 from the previous week's revised level. The moves Thursday follow bursts across the major averages in the previous session on the heels of a speech by Jerome Powell in Washington, D.C., in which he signaled U.S. central bank officials may downshift the final interest rate hike of the year later this month to 50 basis points. Wednesday saw the S&P 500 bounce 3.1%, the Dow was up 2%, and the Nasdaq was up 4.4%. Quote, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down, Jerome Powell said, speaking at the Brookings Institution as he acknowledged the uncertain lags of monetary tightening. That's kind of what I was talking about earlier. The time for moderating the pace of rate increases may come as soon as the December meeting. Powell's comments are likely the last public remarks he'll deliver before the Federal Reserve officials enter a blackout period, a time policymakers limit public speaking prior to a policy-setting meeting ahead of their next gathering December 13th and 14th. Here's another quote. The focus now should not be on the pace, but how much higher rates will need to go and how long they will need to stay there, Jason England, global bonds portfolio manager at Janus Henderson Investors, said in a note. As the Fed will need to see substantially more evidence that inflation is easing before they pause, and Powell ended his speech by saying, history cautions strongly against prematurely loosening policy. And we could see that from the 70s and the 80s. Sentiment got a boost Thursday from easing concerns over China's zero COVID unrest after top government official Vice Premier Sun Shunlin urged an optimization of the nation's virus response as pathogenicity weakens. Meanwhile, on the corporate side, all eyes were on Salesforce following news co-chief executive officer Brett Taylor would step down in January and co-founder Mark Benioff would become the sole CEO. So let's get into the S&P 500. Really interesting price action. We kind of touched the 200-day moving average and actually bounced off of it, which is what I meant by we could be seeing some bullish signals in the market technically, even though we don't know how long that'll hold true. It did bounce off the bottom of this zone as well at the 4100. So some indecision here on the S&P 500, and it actually closed again kind of right on the trend line. So we're still right on this trend line that's held true since the start of this bear market, and it's what I'll be watching closely. I don't think a breach of this trend line would be insignificant. So we weren't really able to breach it today. We're right on it. And it's why I kind of expect some selling in the next couple days, because I don't know if we're in a place to break through this yet. So that's what I'm looking for on the S&P 500. I'm just watching this trend line like a hawk, really, trying to see what's going on here. And it could get pretty volatile in the next couple of trading sessions. Bitcoin, Bitcoin's honestly been kind of boring since I started this channel. It was in a range for like the first 5 months, and now it's broken lower and just kind of consolidating now underneath the range it was before. I still fully expect to see at least the 12,000 on Bitcoin, if not 10,000 or lower. But yeah, I don't like Bitcoin here. It's definitely not a bad place to start investing in Bitcoin, as it's like 80% down from the highs, but I still think we could see significantly lower prices on Bitcoin in the near future, especially if this market takes another leg down. So that's what I'm looking at. Always remember to manage your risk. Don't fall for the FOMO. Don't go all in when everybody else is going all in, because that's how you're most likely to get washed out. I really do appreciate everybody listening to this episode. Hope you took something from it. If you did, please subscribe on YouTube and follow wherever you listen to podcasts. And I'll see you guys tomorrow. So thank you.